This is the Daily Market Rundown live from the Tradelo Trading floor. It's January the 16th. Some highlights from today's show. US CPI remains very elevated. The VIX has been squashed for now. And OPEC news is incoming. Good day traders and welcome to the Daily Market Rundown. Let's talk a little bit about some of the overnight moves. There's not a great deal going on, and that's pretty much to be expected given some of the movement and flows we had post the US CPI yesterday. Now, let's get stuck in. Before we actually move to the CPI and look at the charts, let's talk a little bit about something to pay a little bit of attention to today, which is ultimately Scott Bessent or Bessent is going to be talking. He's going to be in Washington talking in front of the people that ultimately give him his job at the end of the day. Now, he has ultimately given his prepared statement. We kind of know what he's going to talk about, but I think this is a good time to actually just get an understanding of Benson himself. He obviously will be critically important to learn about him as a trader, because the things he says ultimately are directives coming straight from President Trump. Now, if we go back and we look at Trump's first presidency, we know he was very much in the camp of lower yields and a weaker dollar. Why? Well, he was of the belief that everyone was taking advantage of America, running weaker currencies against America, and as a result, America was ultimately losing out to a lot of business offshore. So he was very much adamant that he wanted a low rate environment as well as a much weaker dollar. Now, in a moment, I'm actually going to get you, we're going to segue onto the dollar index and talk a little bit about that. But it's very, very important to understand that right now, Benson hasn't really adopted that stance of wanting a weak dollar. But of course, we're not yet into the Trump presidency. So just be aware that those were key themes during Trump's first presidency. Apart from that, he's very much going to talk about the United States dollar and how it's critical that it does remain the world's reserve currency. I do think something to watch very closely for. If you're telling the world that you think the United States dollar should remain the reserve currency of the world, it's going to be very difficult to throw into that sentence this idea that the Bitcoin is going to be used as a reserve held by the Treasury. So watch some of Benson's comments, particularly if you're a Bitcoin trader, if you trade or if you're sort of holding that long term, because there is quite a lot baked into the price now, this idea that the United States government will start purchasing Bitcoin and holding them as a reserve. So keep a close eye. There's a couple of themes that could come from Bessent, perhaps not today, but definitely over the course of the next 12 months. He is someone we want to learn about. Now, let's move on to our second key news topic from yesterday. It was all about CPI, and I think there's a real key takeaway from this, because the market took it as the porridge was not too cold, not too hot, just perfect type scenario. Why? Well, look, there was perhaps some expectation that, given the trend of inflation over the last couple of months and given the stickiness of it, particularly on the core side, would be that, there could be a possibility for a bit of an uptick. And the reality was it pretty much came bang in line. Even if we look at the core that did come in at 0.2 rather than 0.3, it very much was a decimal type thing. So net and net, the inflation print yesterday came out mostly as expected. Okay, why does that matter? Well, the reality is that the equity market staged quite a significant rally off of this idea of, it was a combination of things. One, it was, well, you know what, so long as inflation doesn't tick up, it will ultimately give the Fed that opportunity to cut again at some point next year. Now, keep in mind, the market pricing right now is for one cut only. If we fast forward all the way out until the end of next year, 2026, the market's only pricing in around 50 to 60 basis points of cuts. Okay, in other words, there's not a lot of cuts priced into the market now. And that number that we got yesterday, it kind of opens the door to the idea that perhaps there are a few more than the 2 cuts priced over the next 2 years. And that's why, the equities really loved that print. But also, don't forget, we did see the 10-year bond yields come off quite dramatically. So it was a combination of factors that really gave the equities that sort of bid up in the market. Also, there were some shorts, of course, in the market. So A combination of factors, and we'll talk about the implications of that going forward. But what I want you to take away from this chart, as you can see, is that this is the headline number. And this is something that should be a little bit unsettling for the Fed, where if you go back over the last 2 years, it's been very much about core inflation being stuck. They wanted to see more evidence that core inflation would keep coming down because headline inflation very much was where they wanted it. The reality is we started to see a little bit of an acceleration in this headline print now, and that, of course, will prove problematic. Why are we starting to see a little bit of acceleration? Well, there's a number of factors. I think one of the key takeaways was prices paid that we are seeing in the PMI data, but also keep in mind we're starting to see a little bit of a re-acceleration in the prices of oil. Okay, and that's going to feed back into this headline print over the next couple of months. And keep in mind, 0.4, 0.5 is not that far away from where we were printing back in 2022. Okay, so we're not out of the woods. I think that's the takeaway yesterday. Yes, the equities may have staged a bit, but that had nothing to do with the inflation picture. That perhaps had a lot more to do with the positioning of the market, as well as sort of the concern around yields. Okay, now I mentioned dollar. I think this is an important one to keep a close eye on. This is a chart that will sort of be closely watched over the course of the year, particularly by Donald Trump. He believes the United States cannot afford to be running a very, very strong dollar. And what we can see since Q3 last year is the dollar's up 10%. Now, I appreciate the dollar index is indexed quite aggressively towards the euro, but in reality, the dollar is outperforming every other major currency. Okay, we know that to be true. We can see the degree of this rally, of course, over the last 6 months has been really, really steep. Okay, everyone wants to own dollars. No one wants to own anything else. In a world where the United States is growing and nothing else is growing, it makes absolute sense. The point is, path of least resistance is back up to those 2022 highs, and the reality is that, sure, in the near term, I suspect we get a little bit of a drift back towards that 107, 108, a little bit of sideways trade, let the market sort of absorb this overbought sort of price, but at some point we are going to stage that bit up. Now, again, why I say this is probably going to be true, well, the reality is if we look at the purple line, that is effectively Fed fund futures, or the expectations for rate cuts over the course of the next 2 years, it's very much flat. Okay, there's very little in the way of price cuts being priced in the US economy, whereas if we look at Europe, we look at the UK, we look at most of the other G7, they're all pricing in more additional aggressive cuts over the course of the next 2 years. Okay, so that does make the dollar the standout, but the reality is this does run counter to what Donald Trump wants. Okay, and that's why I think dollar, there's going to be a lot of volatility over the course of this year. This is one chart in particular you want to keep very close attention to, because Trump is going to want a weaker dollar. How he gets it, that's open to question, but this is the kind of market that you want to pay attention to this year, given the nature of the volatility that's incoming. Okay, now a little bit of things to talk about from yesterday. VIX got squashed. This is a chart I pointed out in the Discord channel, and I pointed out very clearly, note the lower high that we had in December, note the lower high that we had effectively in January, and we can see that the VIX is staging this series of lower highs despite the fact that we are having a little bit of a corrective type move in the indices. Now that's important because what we can see, particularly on the purple line is just the 10-day average. Okay, so when I look at vol or volatility, I don't like to look at it in absolute terms necessarily. I like to look at the trend of the 10-day average. Why? Because that gives me a contextual understanding of what structure the market's currently in. Okay, now what I want to point reference to is if you go look back at May, June, July last year, we had a very, very low VIX. Same thing Jan, February, March, April. Now when we have a low VIX, and when I mean low, I mean when the 10-day average is moving sideways like this and it's relatively low, that is the kind of conditionings in which markets should stage not just a small rally, but a significant rally. Okay, now keep in mind the whole of Wall Street is expecting a double-digit return from the indices this year. We are currently sitting slightly down on there, marginally down, depending on which index you look at. But ultimately, we can see that the VIX was a little bit elevated to start the year. Should we start to move back low and start to trade in and around that 15, 16 mark, don't be surprised to see equities begin the process of now starting to get to work pricing in some of the gains for the year. Okay, keep a very close eye on the VIX. I think so long as that keeps squashing down the page, you're going to keep seeing equities ascend towards those record highs. Now, what stops that thesis? What's problematic? Well, we know that this has been a theme since the start of this year. High yields are proving problematic for the VIX. When we do have high yields, that does create an elevated VIX. So it's very much going to be the yields that are going to drive ultimate volatility. What we can see, and this is crucial, what has driven this rise in yields is very much this sort of breakout that we're seeing in long-term break-evens. In other words, there's an expectation from market participants that inflation is not, well, it's not as, sort of structured as the Fed makes us to believe. They believe that, we're going to see this continued disinflationary trend. In reality, the market's not saying or seeing the same thing. Okay, you can see that break-evens broke out effectively starting in December. They broke out of this 2.5%, and the market's saying, look, we are going to have higher inflation down the line, and we're not going to get that 2% target that the Fed seems to think comes in 2026. Okay, keep a close eye on break-evens. Should we start to see those break-evens pull back, fine, all bets are off. We will then, of course, see equities continue to stage that rally into record highs. But so long as these break-evens, remain elevated, and more importantly, so long as that 10-year sits up above that 4.5% yield, okay, there is every possibility that VIX turns, and those equity indices are vulnerable to another leg lower in this corrective move. Okay, keep in mind the S&P 500 is currently staging a bit of a corrective move. It's not done yet. We could still have a deeper move, but it's all going to be determined ultimately by what yields do. Okay. What that means, however, short term, look, reality is yields are overdone. We've done quite an extensive move. We moved from 360 up to 480 in a space of, call it 3 months. That's quite aggressive for the bonds. So don't be surprised to see a little bit of a drift back up to that 4.5%. Once we get to that 4.5%, I suspect we get a bit of two-way trade. And then again, like I said, if this is a strong US economy, if inflation break-evens keep rising, that yield is going to push to 5%, and that is going to pull the equities a lot lower. Okay, so it's a bit of a waiting game now. It's a bit of a sort of if and then. There's two sort of hypotheses. But right now, like I said, inflation is not controlled. Yesterday's inflation print does not negate these inflationary pressures. Yesterday's move was very much driven by a little bit of price action and, of course, the suppression in yields. Now, finally, another sort of theme to pay very close attention to is that of oil. We're up 10% on the year. Okay, and don't forget, oil touches everything from an inflationary standpoint. This is going to be problematic for every central bank because this little rally is going to feed into the headline inflation prints. Okay, keep in mind most central banks are talking about rate cuts, but with oil up 10%, obviously that is going to start to cause some ripple effects. And again, it's not necessarily about oil being up at 79s for a day or a week or a month. It's very much where is that average price over the course of the next couple of months. Okay, hence why we've got the 50-day average. You can see 50-day average is still very contained around that $71. But should this start to drift up, should a month or 2 or 3 from now, the average price of oil be around $78, $79, $80, that's going to create a bit of inflationary pressures at a time when central banks have got sticky inflation. Okay, finally, one note on oil, or two notes on oil. One, we can see a large degree of this move has come from a combination of we're starting to see a little bit of the 1 month, 3 month spread move further into backwardation, and the result is ultimately that tightening is showing us there's a little bit more demand coming for WTI oil. Now, the sanctions that we obviously had from the US seem to have been front run. It looks almost like someone had that information ahead of time, hence why we started to see that sort of spread move well before those sanctions were announced. Of course, what do those sanctions mean? Well, roughly 1.5 million barrels are removed from the market hypothetically, but don't forget Mr. OPEC. Mr. OPEC is sitting on the sidelines ready to pump in another $1 million barrels as soon as they can. Okay, so keep in line, I think one of the key news flow you're going to get perhaps in the next couple of days is that OPEC is now ready to bring back $1 million barrels of supply back to the market because of two things. One, that Russian oil leaving ultimately creates that gap for them to come now and provide that supply, as well as, of course, we are seeing oil prices a little bit more elevated. Okay, so don't be surprised if we get a bit of news flow around oil. I suspect OPEC is going to make an announcement shortly, and I suspect now more than ever they've got an opportunity to bring that supply back to market given the sanctions. Okay, so there's a number of things going on there. Of course, what will that additional supply do to the market? Well, we'll have to wait and see, but the reality is that it should be a very good tradable opportunity. Why? Because oil prices are overbought in the near term. Okay, so there's a lot of longs in the market, so we should see a good, decent move back down towards $74 a barrel should we see that OPEC announcement coming in the next couple of days. Okay, that's a wrap then. If there are any other questions, do get them out into the Discord chat. If there is any other feedback you want to give, of course, use the channel. Otherwise, good luck out there. As always, manage that risk. Most importantly, go make some money.